In this segment of the video, we're going to go through some additional net present value calculations. So we're going to expand our net present value knowledge, including looking at choosing between different alternatives. So all cash flows and all cash inflows have to be included in the solution under each alternative. No effort is made to isolate the cash flows that are relevant to the decision from those that are irrelevant. And the net present value is computed for each alternative. And then we compare those net present value numbers. So Wright Company has two alternatives. They remodel an old car wash or remove an old car wash and install a new one. The company uses a discount rate of 10%. And then the annual revenues and operating costs for the new and old car wash are given. So we have a net of 60 for the new and 45 for the old. And then if we install the new washer, it costs $300,000, has a productive life of 10 years, a salvage value of 7. We have to replace the brushes for a cost of $50,000 at the end of 6 years. And we get the benefit of selling the old equipment, which will give us $40,000 at the time we replace the old equipment with the new equipment. So looking at the present value of this alternative, what do we have to do? Define all of our variables. So we're going to get the cash flow from selling the old equipment of 40, and then it costs $300,000 for the new equipment, giving us a negative 260 cash outflow today in period 0. Annual net cash inflows are going to be $60,000 for the new washer in year 1 to 5. In year 6, you'll get the 60, but you also have to replace the brushes for a $50,000 outflow. So the net benefit in year 6 is only 10. And then in year 7 to 9, you're getting your 60. And then finally in year 10, you get your 60 annual plus 7 for the salvage value of the new equipment. You plug all that into your HP10b and you'll see 83,149 is our answer. Let's try that out. So 260,000 negative is cash flow 0. Then 60,000 is cash flow 1, 2, 3, 4, 5. Then 10,000 for cash flow 6, then 60,000 for cash flow 7, 8, 9, then 67,000 for cash flow 10. And then we have to put in our discount rate. I already forgot what that was. 10%. So 10 is our I, and then I hit the shift and NPV, and I screwed something up along the way. Let's try that again. 10 is I, shift NPV, and there you go. I must have hit the wrong button when I put in my I. So 83,149 is the net present value, which means this opportunity is earning more than the minimum. How much more? Well, why not do a little IRR and find out we're earning 17%. So we knew we were earning more than the minimum, but we know how much by looking at IRR. We're earning 17% by investing in the new washer. For the old washer, if we remodel it, it costs $175,000, and we're going to have to replace the brushes at the end of 6 years. So looking at our cash flow 0 would be $175,000 outflow. Then we'll get only $45,000 as our profit each year for 1 to 5. Year 6, we're going to get that 45, but we also have to replace brushes for a cost of $80,000. That was listed in this slide here. And then that gives us a net outflow in year 6 of $35,000. And then in year 7 to 10, I'll get my annual inflows of $45,000 in each year. Doesn't say we're going to sell the car wash at the end. The old equipment's not going to be worth anything because it doesn't tell us there's a salvage value. So there's no extra bonus in that final year. Again, we're just going to pop it in our calculator. We're going to start with 175. That's going to be cash flow 0. I screwed up again and didn't put it in as negative. So let me try again. Then 45 is cash flow 1, 2, 3, 4, 5. Then 35 negative is cash flow 6. Then 45 positive is cash flow 7, 8, 9, 10. And then I is 10%, and our NPV is 56,348. So the NPV is lower, so the new opportunity is better than the old washer. We can also get our IRR, which is 17.58. So the initial investment is less, which is why even though the net present value is higher for the new washer compared to the old washer, the IRRs are very similar. And the reason for that is because of the initial investment being less for the old washer. So if we compare the net present value, there is a higher net present value for the new washer, so we would be in favor of the new washer. However, that doesn't take into account the fact that there's more of an initial investment needed. So if money is short, we may decide that remodeling the existing washer is the way to go. But if we compare the NPV and make our decision based on that, investing in the new washer is preferable because it has a higher NPV. Sometimes our decisions don't involve revenues at all, they just involve costs. In that case, we're going to choose the alternative that has the lowest cost. So Home Furniture is trying to decide whether to overhaul a delivery truck now or purchase a new one. They use a discount rate of 10%. The old truck, to overhaul it, costs $4,500. The annual operating costs are $10,000, and we'll get $250 at the end of 5 years back. The salvage value now is $9,000. We'll only get that if we sell it and buy a new truck, which costs $21,000, has annual operating costs of only $6,000, and a salvage value of $3,000 at the end. So you have to define your cash flows. For the new truck, we have our purchase price of $21,000, but then we'll also get the benefit of selling the old truck. So the net outflow is only $12,000. Cash flow 1 to 4 gives us $6,000 in operating costs. Cash flow 5 is $6,000 in operating costs, but we get $3,000 back for salvage value, making a net outflow of only $3,000. Then we have the new truck. The overhaul cost is $4,500. That's in cash flow 0 today. Annual operating costs are $10,000. That would apply for years 1 to 4. In year 5, it'll be $10,000. But then we also have the $250 that we get when we sell the old truck. So the outflow in that final year is only $97.50. In both of these, the answers come out negative. I didn't put the negative sign in. So please note in our calculator, when we pop it in, we will get negative answers. And in this case, because we're dealing with costs, we want to choose the least negative, which is still effectively the highest present value, right? The smallest negative is the bigger number. So when we do this, let's just verify that this works. $12,000 is going to go in as a negative for cash flow 0 for the new truck. Then $6,000 as a negative for cash flow 1, 2, 3, and 4. And then $3,000 as a negative for cash flow 5. And then we hit our NPV. And I forgot my discount rate, which is 10. We hit our NPV and it's $32,882. Notice it's negative. The other thing you want to pay attention to is if you do get an answer, like that's a round number, like I did initially, it might mean you forgot your I. That's how I knew I did it. I forgot my I and I was wrong. For the old truck, it's $4,500 rather, negative for cash flow 0, and then $10,000 negative for cash flow 1, 2, 3, 4, and then $97.50 negative for cash flow 5. I'll intentionally forget to put in my I. Look at my NPV, see how it's all round. So that tells me I probably forgot to put in my I, so pop that in. And there's the answer, 42,253, also negative. So what's better? The bigger NPV is better, which is 32,882. May seem a little weird because 32 is smaller than 42, but because we're dealing in negatives, the 32 is better. So the net present value of the cost associated with the purchase of the new truck is better than the net present value of the cost associated with the old. Effectively, the old truck costs more money to run than the new truck would. So that's why the new truck is better.